Private credit markets sidestep a crisis that would cripple most investors. And number one is something almost nobody guesses. Stay tuned until we reveal that hidden safeguard at the very end. Imagine a time before the term private credit existed, when banks dominated every loan. In the early 1990s, a handful of boutique firms began extending capital directly to middle-market companies, sidestepping traditional banking regulations. These pioneers saw an untapped demand for flexible financing, especially for firms too small for public markets. Their modest balance sheets relied on steady investor capital, but they had no formal liquidity framework. As the industry grew, the need for structured cash flow management became evident, setting the stage for the complex safeguards we explore later.
Surprisingly, within a decade, the boutique lenders coalesced into dedicated private credit funds, attracting institutional capital hungry for higher yields. These funds pooled money from pension plans, endowments, and sovereign wealth, creating sizable portfolios of loans. With larger pools came the temptation to promise more frequent redemptions, testing the fund's cash reserves. Early managers learned the hard way that without disciplined liquidity planning, a sudden wave of withdrawals could force fire sales of assets at distressed prices. This lesson spurred the first generation of liquidity buffers.
Few people know that the concept of a liquidity buffer in private credit mirrors bank reserve ratios, but it was adapted for liquid loan portfolios. Fund managers began setting aside a percentage, often 1015%, of assets in highly liquid securities such as treasury bills or high-grade corporate bonds. These buffers act as a shock absorber, allowing funds to meet redemption requests without disrupting the core loan book. Over time, the size of these buffers became a competitive differentiator, with some funds advertising enhanced liquidity as a selling point.
Hidden in the fine print of many private credit fund agreements are redemption gates, mechanisms that temporarily suspend withdrawals when liquidity stress spikes. Typically, a gate triggers if redemption requests exceed a set threshold, often 5% of net assets in a quarter. Coupled with notice periods ranging from 30 to 90 days, these tools give managers a crucial window to marshal cash or arrange secondary sales. While critics argue gates limit investor flexibility, they have proven effective in preventing forced asset liquidations during market turbulence.
When the first wave of redemption pressure hit in the early 2000s, funds discovered a lifeline: secondary markets for private credit interests. Specialized platforms emerged, allowing investors to sell their stakes to other qualified buyers rather than to the fund itself. This secondary liquidity reduced the reliance on gates and buffers, creating a more fluid ecosystem. However, secondary prices often reflect a discount to net asset value, especially during stress, underscoring the trade-off between immediate cash and valuation.
Deep beneath the headline yields lies the art of covenant design. To safeguard cash flows, managers began tightening loan covenants, adding requirements like minimum EBITDA coverage ratios and stricter reporting. These protective clauses reduce default risk, ensuring that borrowers can continue servicing debt even when broader markets tighten. By structuring loans with staggered amortization and bullet payments, funds can better align cash inflows with potential redemption outflows.
When regulators started scrutinizing alternative assets, many private credit managers adopted rigorous stress testing regimes. They simulate extreme scenarios, such as a sudden 30% drop in loan recovery rates or a sharp spike in interest rates, to gauge buffer adequacy. Results guide adjustments to liquidity reserves, gate thresholds, and portfolio composition. This proactive approach mirrors bank stress tests and has become a best practice across the industry.
Suddenly, global regulators began treating private credit more like traditional banking, demanding greater transparency on liquidity risk. In 2024, the European Securities and Markets Authority issued guidelines urging funds to disclose redemption terms and buffer sizes publicly. This push for openness forced managers to standardize reporting, making it easier for investors to compare liquidity profiles across funds.
Later, to further mitigate redemption strain, many firms introduced co-investment vehicles, separate entities that allow investors to take direct exposure to specific loans without affecting the main fund's liquidity pool. Club deals, where a small group of investors jointly fund a large loan, also spread risk and reduce the need for broad redemption support. These structures create a layered liquidity architecture, enhancing overall resilience.
Finally, the next frontier lies in AI-driven liquidity forecasting. Emerging platforms ingest real-time market data, borrower performance metrics, and redemption trends to predict cash flow mismatches days in advance. Early adopters claim these models can adjust buffer levels dynamically, reducing the need for blunt gates. While still nascent, this technology promises a more agile private credit landscape, where liquidity risk is managed with surgical precision rather than broad strokes.
We've traveled from the humble origins of private credit to the cutting-edge liquidity tools that keep these funds afloat when redemption storms hit. The story shows why understanding these mechanisms matters for anyone watching the financial landscape. If you enjoyed this journey, hit the like button and subscribe so you don't miss the next mind-blowing list we drop each week. Which liquidity safeguard surprised you the most? Tell me in the comments below. Thanks for watching, and see you in the next episode.